In the March 2024 budget, the Chancellor announced the end of the furnished holiday let tax regime. Does this mean the end of holiday lets, and how will this affect holiday let investors, both short term and long term? We'll answer these questions and more in this episode of the Property Tax Show. Hello, I'm James Poyser.
And I'm Nadeem, Head of Tax here at Provestor, the Property Accountants.
In April 2025, the furnished holiday let tax regime is coming to an end. Does this mean the end of FHLs? And that's the topic that we're going to be exploring now with Nadeem. So Nadeem, my understanding is with FHLs and the end of the tax regime, there's five key things, five key ways it's going to impact furnished holiday let operators. We've got mortgage interest relief, the way that profits can be split between owners, impact on people's pensions, and the two big ones are around people selling holiday lets and also refurbishing holiday lets. So let's go through these one by one and unpack and understand what this means for FHL operators. So the first one, Nadeem, is about mortgage interest tax relief. So first of all, what is this? How's it going to impact FHL owners come April 2025? What questions do they need to consider?
Yeah, I mean, we've talked about mortgage interest relief on other property tax shows, and it's something that's really impacted landlords, since 2016 when it came into place. So this is your Section 24 mortgage interest rules, which has impacted people who are, high rate earners where they can't get full mortgage interest deductions off their property portfolio, and it's restricted to 20% for high rate earners. This rule didn't apply to furnished holiday let businesses, so trade businesses, and therefore it became a real key thing for furnished holiday let landlords, because actually they could keep their profits low because all their interest was deductible, and pay less tax. Okay. So the actual introduction of the removal of such a relief for furnished holiday let owners is going to be quite substantial.
Okay, and so this means come April 2025, you're no longer going to be allowed to fully claim your mortgage interest as tax-deductible expense. So therefore, you can expect, if you're a high rate taxpayer, for your tax bill to go up.
To go up, yeah. For personally owned owners, yeah.
Okay. So what questions do you think an FHL operator needs to be considering right now when it comes to the impact of the mortgage interest relief?
Absolutely. Well, they need to be doing some forward planning. So they need to understand actually at the moment where their profits are in terms of, their tax brackets as a result of being able to maximise their full mortgage interest deduction, and what that would mean for post-April 2025 in terms of what that does to their tax bracket and what that does to their total tax figure ultimately, because it will absolutely increase their profits and therefore increase their tax.
Okay. And we know that in the buy-to-let sector, lots of people have, when they're buying buy-to-let properties these days, are now buying through limited companies rather than buying personally. Do you foresee the same thing happening in the furnished holiday let sector?
Yeah, absolutely. Because again, the reason why a lot of people were using limited companies was because the Section 24 rules didn't impact them, and therefore it was promoting the kind of use of limited companies. Whereas that wasn't the case with furnished holiday lets, but now it could well be that it's going to be a surge of people using limited companies potentially to kind of not be falling foul of the Section 24 rules in their personal name.
Okay, great. So that's the first point, mortgage interest relief. The second point, Nadeem, that we've been talking about is splitting profits between joint owners. And I understand there's quite a bit of flexibility in FHLs, and it could be that's coming to an end in April 25 as well. So again, can you explain to us what this is, how it's going to impact FHL operators, and the things they need to be considering over the next few months?
Yeah, absolutely. I mean, when we talk about normal investment properties, when it comes to jointly owned with husband and wife or children, etc., the normal rule to follow is that it's you declare the amount of profit that you own in that property. And that was quite restrictive, because if you were a high rate earner and you had a property 50-50 with your wife or husband, you would have to show 50% of the income, regardless of what your tax brackets were or their tax brackets were. With FHLs, you had a little bit more flexibility because you're running it as a business. You could actually income split however it was more tax efficient for you. So if you, as a husband, wanted to show more or less because you're earning money out, income elsewhere, you could. And actually, year on year, you could change the amount you were declaring of your FHL income to suit your tax brackets and your tax thresholds. Whereas now, that's no longer going to be the case, and you will have to show your income based on how much of the ownership of the property you have. And therefore, again, from a tax perspective, it may not suit actually having the property in your personal name, because it might push you into the next threshold.
Okay, so that sounds like quite an interesting question to unpack with a tax advisor, because at the moment you've got this flexibility. You can decide year to year what's going to happen with the profit. Is that going to person A or person B? Going forward, you're not going to have that flexibility. So it's really important to get some advice right now. Get things in place for April 2025, so you're getting that profit split in the way that works for you.
Absolutely. Yeah.
Great, thank you. So the next point, and I don't think many people have kind of noticed this one yet, is the impact on pensions. So how does an FHL and your income from an FHL impact your pension?
Yeah. Not many people know about this, James, because it's not one of the highest sort of priority of issues that people consider with FHL. But actually, because we're running an FHL as a trade, a business, HMRC classes as net relevant earnings for pension purposes. So that means when you make contributions into your pension scheme, it's based on actually how much relevant earnings you actually earn in the year to be able to make tax-free contributions into your pension scheme. Investment properties, i.e. your standard buy-to-let properties, are not classed as relevant earnings for pension purposes. It's an investment income. FHL property income was classed as, or is at the moment, classed still as a net relevant earnings for pension purposes. So it significantly increases your relevant earnings to be able to put more money into your pension, tax-free. So again, really beneficial for people who don't have any other forms of income and were relying on their FHL income to keep their relevant earnings at a certain threshold to be able to contribute into their pension scheme. So if we're now winding that away from their relevant earnings pot, their net relevant earnings are going to decrease considerably, and the amount of tax-free pension contributions will also decrease. So a little bit of planning will be required there, because if they were relying on that, that's going to go. If they want to make a more advanced contribution now, that's something they need to be thinking about, because that will, post-April 2025, be removed, and therefore their net relevant earnings are going to wipe away quite quickly.
Yeah, okay. So, I mean, already these first 3 points we've said, if you've got a mortgage on your furnished holiday let, you're going to be impacted. If your furnished holiday let is jointly owned with you and your spouse or another partner, then you're going to be impacted. If you are paying into a pension, you're going to be impacted by this legislation change. And in a second, I'm going to talk about also there's quite big repercussions if you're thinking about selling your furnished holiday let, or think about selling it and buying another one. And also, if you think about refurbishing it as well, or any significant investment in your furnished holiday let property. Before I go on to those two really big ones, tell me about what should people start to be thinking and doing, right? Because it's not just about your FHL, right? You've got to take that step back and start to understand personal tax situation, where you're going and what your goals are. So what's your general recommendation for people at the moment when it comes to thinking how do they respond to April's changes?
I mean, more now than ever with the changes that are coming into place next April. So, just basically a year, or just over a year of planning we've got left. We've already talked about the quite significant amount of tax things that are going to impact people, and that will impact anyone from one FHL to having a portfolio of FHLs across different taxes we've talked about. So really understanding what they will be doing with this FHL portfolio or property in the short, medium term, and actually what does it mean for you in the absolute short term, because come April, which is only one tax year away where we are now, there's going to be a significant impact on pretty much everyone who owns FHL property. So actually sitting back and understanding what that means for you personally, what does that mean for you come April 2025, but actually what that means for you in the next 3, 4, 5 years, because you might have gone into the FHL world because of the financial rewards, but those financial rewards could be tapered out very quickly, i.e. next April. So what does that mean? How do you exit from this? How do you remain in this in the most tax efficient way? And have you thought about what's around the corner?
Yeah.
So we have consultations with clients on a daily basis with FHL, and it's really key for individuals to understand, clients to understand actually, when they're in the FHL world, what tax benefits you were receiving and what will happen once they've kind of been pulled away from your feet.
So give me a really quick summary then. So you mentioned there that we do tax consultations for FHL owners. So if somebody's got an FHL and they call through to your team and say, right, I need to unpack this and understand what's going on, just tell us briefly the process. What happens? What does your team do? What do you help them with?
Yeah. I mean, typically, where every individual landlord comes with their own specific questions. So what we normally ask for is for a bit of a fact-finding document in terms of what specific questions they have. It allows us to sort of prepare for the call, take the consultation, and we run through all the tax consequences that they're going through, issues they're going to have, and follow that with a sort of audio recording of the call. But we cover everything on FHL. So anything from someone who's just about to spend their first amount of renovation on their first FHL to someone who has a portfolio of FHL properties and they're thinking of exiting. So it's a breadth of questions that we go through.
Yeah. Okay. Great. And what we'll do, we'll make sure we put a link below to the tax consultations. Thanks, Nadeem. So let's move on to the next two really big changes that are going to impact FHL operators, and that's one about selling an FHL and the other one about refurbishing. Two big significant events for FHL owners. Let's talk about selling your FHL, and this is all down to business asset disposal relief. And if people don't know what business asset disposal relief is, do you mind just giving us a quick intro, quick summary of what that is and what the impact is on FHL owners?
Yeah, so business asset disposal relief is effectively a capital gains tax relief available for businesses who sell their assets or you sell a business effectively. And what that is you get a lifetime allowance of £1 million per person, and it allows you to basically pay tax at the basic rate of 10%. So regardless of how much you sell that business for, up to the £1 million per person in your lifetime, you can actually pay 10% on the sale of that business effectively. So you could sell that furnished holiday business, claim business asset disposal relief, and only pay 10% as opposed to the high rate of 20% if it didn't qualify as a business asset. So it's really advantageous for people who are thinking of exiting. We know people don't go into this world to think about exiting, but if it was something that you were thinking about doing, actually the business asset disposal relief is a really, really tax advantageous way of utilising that to sort of exit from your business.
Okay, and that comes to an end in April 25. Right, so if you are starting to evaluate whether you're going to hang on to your FHL or sell it, now's the time to run through these questions with a tax advisor and figure out, is there a case for you trying to accelerate that sale?
Yes.
Or whether it's not making much difference to you.
And there are other capital gains tax reliefs, I'm sure we don't have time to go through today, but like business asset rollover relief, where you can actually dispose of that asset, buy another one and roll the gain over. Again, if you were thinking of selling a weaker asset to buy another asset, that's something you could take advantage of potentially.
Great. I mean, that's a really good point, right? Because I know that your team pushes this home a lot to property investors, the constant evaluation of your portfolio. And an exit doesn't have to mean an exit completely. It could be exiting an underperforming property and reinvesting in a brand new property. And what we're saying here with the rollover relief, it might be that you're looking to get rid of an FHL that isn't working hard for you, but you have something else on the horizon, and this allows you to do that in a really neat, tax efficient way.
Absolutely.
Okay, so it could be that you're looking to sell, it could be looking to sell and buy another one.
Yeah.
Both of those things, get some advice well before April 2025, work that out with your tax advisor and figure out if that's right for you or not. Okay. The final point is about expenses. Now, expenses, we'll touch on this because expenses are treated differently and quite advantageously for FHL operators. So tell me, why? What's the impact of this? How's this going to impact FHL operators? And particularly questions around refurbishment, because I think that's the key thing that we need to unpack. So first off, Nadeem, tell us about expenses for FHLs today and how it's going to be.
Yeah, I mean, one of the biggest advantages of running a trade, a business, again, use those terminology under a furnished holiday let, is that you can benefit from allowances such as capital allowances, which is obviously a way of you being able to 100% allow for expenses on any capital items. So that's, any fixtures, fittings, white goods, integral features of the building. So this could be even electrical equipment, wiring equipment, plumbing equipment in the property. So you can see where we're talking about furnished holiday let, these things do add up. And even on the purchase price of a property, you've already got integral features, integrated in the business, which you can also claim an allowance for. Excuse me. So the really advantageous, shall I say, for anyone who's got a furnished holiday let, because you can 100% allow for these expenses in the year that you've incurred them, which is different to investment properties. We've talked about the difference between a capital cost and a revenue cost, and only being able to deduct certain items off your profits. And capital allowances, obviously with most furnished holiday lets, you're talking about a lot of fixtures and fittings, lots of plant and machinery, because you've got properties with multiple rooms, occupation. So it was a really good allowance to have and reduced people's profits significantly. So the removal of that will have a massive impact in terms of profits.
Yeah,
no doubt.
Okay, and I think about the trend you think about Airbnbs over the last few years, right? It's changed the landscape of furnished holiday lets, and I'm sure you've stayed in Airbnbs, really high-end finishes, very luxurious, hotel-like feeling, away from old school holiday cottages with lino floors
Yes.
that we're all kind of used to in the 80s and 90s.
Yes.
So people have been investing in their furnished holiday lets, putting in nice kitchens, island kitchens, nice appliances, putting extra rooms in, knocking walls out, those big changes. And up until April 2025, that's all good. You can claim that all back on your tax return and you get tax relief on that.
Yep.
Come April 2025, that's no longer going to be the case.
Absolutely.
Right. So you're looking to buy an FHL and refurbish it, or you've got an existing FHL and you are thinking about refurbishing it. It sounds like there's some questions that you need to start asking yourself about what you're going to do between now and April, because that's going to make a pretty big difference to your tax bill come April 2025.
Absolutely, and the advice is not just to go out and spend loads of money because capital allowances are there for you and use them, because actually if the plan is from a long term that actually this FHL may not work for you, or you want to exit this one and buy another one, then using those capital allowances may not be tax efficient in the long term, but they are a really tax efficient way of reducing your profits if you've not already utilised them, and there's scope for you to utilise them in the next year. Then absolutely you should have a conversation to see whether it's worth your while, because again, it really depends on your individual case, what you're spending it on, and the type of property you're spending it on as well. Because if it's a plan to exit, then it may not be worth your while.
Yeah. Okay. Thanks. That's the 5 things that we've covered, Nadeem. I think this kind of leads kind of nicely to the big question that we're asking is this the end of FHLs? The abolishment of the FHL tax regime, is it the end of the FHLs? And I think in that final answer, what you're saying there, Nadeem, is actually you've got to think about the business case for your FHL. And so when it comes to the question, is the end of FHL tax regime, is that the end of FHLs? What do you think? What's your answer to that?
I don't think it's the end of FHL. Absolutely not. I think the government have tightened their belt on FHLs, but actually the demand will still be there. I think you just need to be smart in terms of how you run your FHL. If it wasn't in a limited company, you may think actually using a vehicle like that might be the right thing for you going forward.
Yes.
If you were maximising you and your partner's share and minimising your tax brackets effectively as it was, but obviously that's now been removed, there may be another way of you tax efficiently running the FHL. And of course, financially they do bring in more revenue than a normal buy-to-let property. So there's no getting away from that. It's just how you actually manage things going forward. We've talked about a number of tax things there which affect a lot of individuals. It could be there's certain things which impact you as an individual FHL owner more than the other things. So, if it's purely about pensions, there might be other ways we can maximise your pension contributions than, using the net relevant earnings from your FHL. So it really is a case-by-case basis, and it depends on what the individual's real needs are. But I do not think it's the end of FHL.
Great.
If there's an answer you wanted.
Good, because I'm staying in an Airbnb this weekend. I hope that continues. Fantastic. And it sounds like so if people want to move this forward, a call with the team, having the consultation, and I think everything that you've just said here, Nadeem, is this isn't just about the here and now of tax, of what's going to happen in 2024. It's about stepping back, understanding your personal tax position, your long-term goals. Where does your FHL sit in your long-term goals? And is it still the right bet for you?
Yeah.
Because it may well be. It is. And you just accept it because it's going to move you towards your long-term goals. Or it may be that you look to divest, buy another property, or exit the market completely.
Yeah, absolutely.
And that's what your team are really skilled in helping people to understand what their next moves are.
Yeah, I mean, sometimes we want people to take a bit of a back step, reanalyze everything, see where you're making money, see where you're not making money as you thought, and then dive back in again.
Yeah, fantastic, great. Thank you, Nadeem.
Thank you.
So I hope that was a useful summary of the changes that are coming up in April 2025. If you've got any questions on FHLs, please put them in the comments below and we will try and respond. If you want to chat to our team on a one-to-one basis and understand the impact on your portfolio, follow the link below and book a tax consultation with the team. We can talk to you in the next couple of days. Hope you've enjoyed the show. Please do hit the like and subscribe button, and we'll see you next time on the Property Tax Show.